Welcome back, everyone. And to kick us off this afternoon, we are pleased to welcome Commissioner Ueda. Take it away.
Well, thank you so much, Marcia, and good afternoon. It is so good to see so many members of the advisory committee here in person. So thank you to our guests who will be appearing later on today, Edwin O'Connor and Bo Bohm, for leading the deep dive into encouraging more companies to go public, a topic that is near and dear to my heart. Now, nearly 4 years ago at this committee, I raised concerns about the declining number of public companies and the regulatory headwinds compounding that trend. This current commission is dedicated to reversing that trend and has embarked on a reform agenda to accomplish that objective. While the number of initial public offerings has shown some signs of improvement, that recovery has been uneven, disproportionately benefiting larger and later stage companies. And for the small companies that this committee exists to serve, many barriers still remain. The challenge of going public is particularly acute for smaller companies. Data from today's committee agenda indicates that small companies made up 44% of 2024 IPOs, but raised only 3% of the capital. This disparity suggests that while small companies are still attempting to access the public markets, the economics may be broken. Fixed compliance costs, underwriter economics, and a regulatory framework calibrated for large issuers make it extraordinarily difficult for small companies to raise meaningful capital through a public offering. The result is a public market that is increasingly the domain of large, later stage companies and a shrinking opportunity set for investors who want to participate or earlier stage growth. The consequences of a less hospitable public market for small companies is not abstract. They impact the founder who cannot raise capital, the early investor waiting years for a liquidity event that may never come as an IPO, and the ordinary American who is increasingly a spectator to growth that happens out of their reach. A public market that functions as an exit ramp for private capital rather than an on-ramp for ordinary investors is not serving its foundational purpose. The barriers here are both economic and structural, and addressing only one without the other will not be enough. A healthy IPO market depends on an ecosystem that surrounds the transaction, the analyst coverage that generates investor awareness, the market making that provides post-IPO liquidity, and the institutional interest that contributes to price discovery in the aftermarket. For small companies, this ecosystem has quietly eroded over the years. Analyst coverage has thinned. According to the Office of the Advocate's Small Businesses 2024 annual report, it found that 44% of small and mid-cap stocks have no analyst coverage at all. And we're not counting Reddit. Without coverage, investors may be more hesitant to take positions, which can negatively affect liquidity. Thus, for a small company contemplating an IPO, going public makes little sense if the costs exceed the benefits. Each of these problems reinforce the others, and no single regulatory fix addresses all of them. What is needed are changes to make the small company IPO more viable, and a commission that is willing to take those steps. Ideas such as modernizing the shelf registration process, revisiting quarterly reporting, and reviewing the emerging growth company framework and our outdated filer category thresholds will be valuable first steps. That brings me to the questions I hope today's discussion will answer. Are public company requirements tailored to the companies that need access to public companies or to public capital, or to the companies that can most easily absorb the cost of compliance? What would an appropriately scaled regulatory framework look like? Have the rules governing research coverage, underwriter compensation, and post-IPO market making kept pace with how those markets actually work today? Or are they quietly discouraging the very activity that we seek to encourage? This committee has the expertise and the mandate to help us answer these questions. To all the members of the committee, thank you very much for serving on it and for your continued engagement. The work you do here matters to the entrepreneurs and the investors you represent, as well as the long-term health of our capital markets. So I look forward to hearing from the committee on these important issues.
Great. Thank you so much, Commissioner Ueda. All right, we are going to jump straight back into our conversation from this morning. And one perspective that I don't think we fully considered was about underwriters. And we also heard this in the first question from Commissioner Peirce. So obviously, the investment banks play a critical role in helping companies raise public capital and in shepherding companies through the IPO process. Our robust public markets do not work without the banks. And I'm hopeful that our invited speaker this afternoon will help shed light on how underwriters are viewing the IPO markets, how they help their clients manage challenges, both in the IPO process and vis-a-vis the macroeconomic uncertainties and market conditions, and ultimately what, if any, regulatory changes the investment banks think might move the needle in terms of encouraging more companies to go public. So I am pleased to welcome virtually here, Bo Bohm. Bo is a managing director and global co-head of the equity capital markets practice at Cantor Fitzgerald. He has over 25 years of experience in investment banking and advising clients on equity and debt financing, SPAC transactions, M&A strategy, deal structuring and execution, capital structure optimization, investor targeting, and public-private valuation. So Bo, thank you so much for being here, and the floor is yours.
Thank you very much. Can you guys hear me okay?
We can, yes, that's great.
Okay. And apologies for not being able to be there in person today, but and appreciate the introduction. You did a better job than I would have done for myself. But thank you all for the opportunity to address the committee today. So again, by way of background, I've been an investment banker for over 25 years, during the last 20 of which I've led equity capital markets teams for firms including Deutsche Bank, Wells Fargo, and of course, Cantor Fitzgerald, where I currently serve as global co-head of equity capital markets. Cantor is a leading equity underwriter, ranking in Bloomberg's full year 2025 league tables as the #1 book runner of U.S. IPOs and a top 5 book runner of all U.S. equity offerings. While we work with a broad spectrum of corporate issuers ranging from small caps to mega caps, Cantor has demonstrated a particular strength in leading smaller cap equity issuance. To put this in perspective, in the last week alone, we successfully priced as lead left book runner a $138 million IPO for a sub $500 million market cap industrials issuer. Are pricing this week a $50 to $60 million lead left book run IPO for a small cap silver miner. And we launched this morning another $50 million lead left book run IPO for a company in the rare earth sector. My remarks today focus on specific regulatory changes that would improve the environment for small cap IPOs and for follow-on equity issuance. I've organized the recommendations into 5 areas and will try to be direct about the problem each is intended to solve. My perspective is coming from an equity capital market practitioner standpoint. It should not be viewed as Cantor Fitzgerald's corporate view or recommendations. In terms of the structural backdrop, and some of this was just mentioned, but U.S. IPO volumes for small cap corporate issuers have declined significantly over the past 2 to 3 decades. To put this in perspective, at the end of 2025, there were roughly 3,600 domestically publicly traded operating companies. That's down roughly 30% over the last 20 years, from roughly 5,000 in 2005, and down more than 50% from the 1996 peak of over 7,300. Yet the U.S. economy is more than twice as large as it was in 1996, with half as many public companies. The average number of IPOs ranging less than 200 million in proceeds over that span has declined from more than 400 per year in the 1990s to 50 to 80 per typical year in more recent years. The causes of this are multiple: growth of private capital, increased compliance costs, litigation exposure, but a meaningful portion is attributed to regulatory frictions that are within the SEC's authority to address. The Jobs Act of 2012 was a constructive step. The proposals here build on that framework with additional targeted changes. So the first topic I wanted to talk about is relating to the idea of pre-deal investor education, or PDIE, and valuation discovery. The current framework requires companies to commit 6 to 12 months of preparation time and several $1 million in process costs before receiving any meaningful, tangible feedback from institutional investors around valuation. That asymmetry, full commitment before any price discovery, is a significant deterrent to IPO activity, particularly for smaller issuers where the cost to benefit ratio of the public process is already tight. This, just worth noting, was also a big part of the reason why we saw so many companies in 2020-21 shift toward going public through SPAC transactions as opposed to traditional IPOs, just given the benefit of having some of this valuation discovery in the earlier part of the process as opposed to the end, like you would in a traditional IPO. So the problem in practice: a company begins IPO preparation in January. It selects underwriters, engages counsel, completes audits, and files a confidential S-1 draft. By October, it publicly files, waits through the mandatory 15-day period, and then launches the roadshow. It is only during that 2-week roadshow, 10 months and several $1 million into the process, that it learns what institutional IPO investors truly think the business is worth. If investor valuation expectations are materially below the board's view, the company either prices at a discount or withdraws its IPO, having already incurred the full cost and reputational exposure of a public filing. In the UK, by comparison, this problem is largely solved through the Financial Conduct Authority, or FCA's, pre-deal investor education, or PDIE framework, which permits underwriter equity research analysts to prepare and distribute preliminary research to institutional investors and to conduct structured pilot fishing conversations well before a company commits to the formal IPO process. The result is genuine price discovery before the point of no return. So in terms of proposed reforms, create a formal PDIE safe harbor under the Securities Act, permitting underwriter equity research analysts to distribute preliminary research reports to qualified institutional buyers and institutional accredited investors prior to the public filing of an S-1. Reports should carry clear conflict disclosures, contain no binding price terms, and be explicitly excluded from the definition of prospectus under the Act. Secondly, establish a pilot fishing framework, permitting lead underwriter analysts to conduct structured, documented conversations with institutional investors for the purpose of gathering valuation feedback, conducted in parallel with testing the waters activities and well before any anticipated public filing. Participation by investors should be conditioned on confidentiality agreements. Third, issue an interpretive release clarifying Section 11 liability treatment of pre-deal analyst research under the proposed safe harbor, specifically that properly disclaimed QIB-restricted pre-deal research not constitute a prospectus or part of the selling effort. Without this clarity, banks will not permit research analyst participation, regardless of what the rules technically allow. And fourth, amend Regulation AC to create an explicit carve-out for PDIE activities, preserving all existing conflict disclosure requirements, but permitting analyst involvement in pre-deal investor education distinct from the investment banking transaction process. So why does this matter? Early valuation discovery changes the risk calculus of going public in 2 ways. First, companies that receive constructive investor feedback before committing to a full S-1 process can make better informed go, no-go decisions. And if investor expectations are too far from the board's view, they can stand down before incurring full process costs. Second, companies that do not proceed benefit from a more informed investor base at the time of roadshow launch, resulting in better pricing outcomes and more durable aftermarket performance. The other regulatory reforms on this list reduced friction. This one reduces fundamental execution risk. The second topic I'd like to talk about is IPO timeline compression. The idea here would be to eliminate the mandatory 15-day waiting period for qualifying issuers. The mandatory 15-day waiting period between public S1 filing and roadshow launch creates a window of unhedged market risk for smaller issuers. The company's financials and strategy are publicly visible to competitors, customers, and employees, but it cannot actively engage with investors or respond to market developments. For large cap issuers, typically less sensitive to week-to-week market volatility, this is manageable. For smaller companies, it creates meaningful execution risk. The stated rationale, giving investors time to review the prospectus, is substantially addressed if the PDIE framework that I described in the first section is implemented. Institutional investors who have already reviewed pre-deal analyst research and participated in pilot fishing conversations do not require an additional 15-day silent period before the roadshow begins. For smaller reporting companies and EGCs that have completed a documented PDIE process, eliminate the mandatory waiting period and permit contemporaneous or near contemporaneous S1 filing and roadshow launch, subject to an accelerated SEC declaration of effectiveness. For issuers that have not conducted PDIE, reduce the waiting period to 5 business days, sufficient for prospectus review without the current extended market exposure window. Also, fast-track SEC review for smaller issuers. Average SEC review times for initial S1 filings frequently exceed 30 days for smaller issuers, with multiple comment rounds extending total review timelines to 3 to 5 months. The extended exposure creates its own market risk and discourages smaller companies from entering the process. Create a dedicated fast-track review process for smaller reporting companies, IPOs under 200 million in offering size, or alternatively, a revenue threshold could be used given ultimate IPO size at the time of initial confidential S1 filing may not yet be known. A 10 business day initial comment deadline, maximum 2 comment rounds absent material disclosure deficiencies. Publish expanded interpretive guidance on common comment themes for smaller issuers so that counsels can address them proactively in initial filings, reducing iterative review cycles. The third topic of the 5 I mentioned that I'd like to touch on relates to registration, disclosure, and compliance cost reform. Scaled disclosure for smaller issuers. Create a streamlined registration form, Form S1S, for issuers with revenue below 250 million, where 2 years of audited financials versus 3, condensed MD&A focused on operational metrics, and simplified risk factor requirements limited to material company-specific risks. The current S1 framework was designed for large, complex companies. Applying it to a $75 million revenue issuer imposes costs and delays that are not proportionate to investor benefit. Also, raise the EGC revenue threshold from 1.235 billion to somewhere in the 2.5 to 3 billion range, and extend the EGC accommodation period from 5 years to 7 years post-IPO. The current threshold has not kept pace with market conditions, and the 5-year cliff creates an abrupt transition burden for companies that are growing but remain fundamentally smaller public companies. With respect to SOX 404B reform, create a permanent revenue-based exemption from the Section 404B external auditor attestation requirement for companies with annual revenues below 250 million, or alternatively, a comply or explain framework permitting smaller issuers to opt out with enhanced qualitative disclosure of their internal control environment. Annual 404B compliance costs of $500,000 to $1.5 million for a small cap company are a material recurring burden with limited marginal investor protection benefit at that scale. Management's 404A self-assessment requirement would remain intact. Underwriter economics and liability. The economics of underwriting small cap IPOs are a structural impediment to market activity. For a $50 million IPO, at a 7% gross spread, gross underwriting fees of $3.5 million divided across a 3 to 6 bank syndicate do not adequately compensate for the legal exposure, due diligence, and distribution resources required to execute a quality transaction. Fewer institutional quality underwriters willing to commit to small cap deals means thinner distribution, worse pricing, and weaker aftermarket performance, outcomes that discourage both issuers and investors. In terms of ideas, allow flexible underwriter compensation structures, including additional deferred fees and/or warrants tied to aftermarket performance milestones, without tripping excess compensation, in order to better align bank incentives with long-term issuer and investor outcomes. Secondly, amend the Section 11 underwriter liability framework to apply a proportionate liability standard calibrated to offering size and investor sophistication for smaller issuer transactions. The current framework imposes liability risk that is structurally disproportionate to the economics of small cap deals. And third, eliminate the 25-day post-IPO analyst quiet period and create an explicit safe harbor for underwriter research published from the first trading day. Newly public companies are most in need of investor education immediately after the IPO. The quiet period removes the most knowledgeable voices from the market at the worst possible time. Fourth topic relates to post-IPO capital market access. And I'm going to focus my comments here on traditional IPOs, but some of these topics can also be applied to companies going public through alternative means, including SPAC transactions. A company's ability to efficiently access follow-on capital markets is one of the most important practical benefits of being public. Under the current framework, smaller newly public companies face extended periods of constrained access to shelf registration and automatic effectiveness, precisely when they are most likely to need capital for growth. These restrictions are not calibrated to investor protection objectives. They're legacy thresholds designed for larger cap issuers. In terms of ideas, reduce S3 shelf eligibility from 12 months to 6 months post-IPO. Currently, a company that goes public in January cannot use Form S3 shelf registration until at least the following January. For a company operating in a fast-moving market, a 12-month wait for efficient follow-on capital access is a material constraint. A company that has been public for 6 months, filed 2 quarterly reports, and maintained reporting compliance has given the market a reasonable opportunity to evaluate its disclosure quality. Reduce the S3 seasoning requirement to 6 months for smaller reporting companies and EGCs with a clean reporting record. No changes to the minimum float threshold, otherwise applicable to S3 eligibility. Also, reduce well-known seasoned issuer float threshold. WKSI status, which enables automatic shelf effectiveness and eliminates SEC review delays for follow-on transactions, currently requires $700 million in publicly held float. This threshold excludes virtually the entire small and mid-cap universe from WKSI benefits. A company with $400 million in float must file a traditional S3, wait for an SEC review for what should be a routine capital markets transaction. In terms of ideas, reduce the WKSI float threshold to $300 to $500 million for companies with at least 12 months of public reporting and a clean compliance record. As an alternative, consider a tiered WKSI light framework for companies in the 350 to 700 million float range, where automatic shelf effectiveness after a streamlined, confidential 5 business day SEC review, rather than the full automatic effectiveness available to large cap WKSIs. This preserves a proportionate level of oversight while meaningfully reducing execution timelines for smaller companies. And then the fifth and final topic I wanted to raise is with respect to analyst coverage and aftermarket liquidity. Sell-side research analyst coverage is essential infrastructure for small-cap public companies. Institutional investors need research coverage to justify position building in smaller, less liquid names. Without it, small-cap companies struggle to build the institutional investor base necessary for price stability, liquidity, and efficient follow-on capital raises. The collapse of small cap analyst coverage over the last 2 decades, direct consequence of the 2003 Global Analyst Settlement and Regulation AC, combined with MiFID II's downstream effects on research economics, is a significant structural problem for the small cap public equity market. In terms of ideas, create a disclosure-based safe harbor for underwriter research on companies they have underwritten with clearly mandated conflict disclosures in lieu of the current restriction-based approach. The goal of preventing conflicted research is better served by transparency than prohibition. Secondly, facilitate an issuer-sponsored third-party research framework, research commissioned by the company, but produced by independent analysts with published methodologies and full conflict disclosure. Several international markets have developed workable models here that the SEC could adapt for the US context. Third, review Reg M stabilization restrictions as applied to smaller IPOs and consider a more permissive framework for legitimate aftermarket support activities with enhanced disclosure as the regulatory tool rather than 25-day underwriter research prohibitions. And fourth, issue updated Reg FD guidance for smaller reporting companies, including a safe harbor for structured investor communications that satisfies FD requirements without the legal overhead that currently discourages smaller public companies from engaging proactively with their investor base. So in terms of closing observations, each of the recommendations that I laid out above are independent and could be pursued on their own timeline. That said, pre-deal investor education reform and IPO timeline compression are most naturally paired. The case for eliminating the 15-day waiting period before launching a roadshow is substantially stronger once a pre-deal investor education framework is in place. None of these proposals weakens the core investor protection framework. Disclosure obligations, anti-fraud provisions, and the fundamental registration requirement are all preserved. The goal is recalibration, applying requirements and thresholds that were designed for large, complex public companies to smaller issuers in a manner proportionate to their size, sophistication, and the realistic investor protection benefit at stake. From a practitioner standpoint, the most consequential change would be enabling earlier analyst-led investor engagement. The information gap that currently exists around what underwriters can learn about likely investor valuation before a public commitment by an issuer to launch an IPO is made at a major source of avoidable IPO friction. Closing that gap through a formal PDIE framework modeled on the UK's approach and adapted for the US regulatory context would have a material impact on stimulating small cap IPO activity, in addition to streamlining the overall IPO timeline and associated costs for small cap issuers. I appreciate the committee's time and would welcome any questions.
Great, Bo. Thank you so much. That was very, very informative. All questions? Go ahead.
Sure. Hi, Bo. I have a question. Can you talk more about how the pre-deal investor education would align with, the testing the waters conversations that would occur after you have flipped public? Are you getting new people in the room for test the waters on that price discovery, or how do you see that working in practice?
Yeah, there's a few ways that could work. One idea would be for, again, to maintain independent conversations and work streams from an investment banking process standpoint with an equity research analyst standpoint. You could have effectively the same accounts that are taking part in testing the waters activities also take part in pre-meeting investor education or post-meeting investor education with the equity research analysts of the underwriters. So if you think about how this plays out in a typical IPO roadshow, so once we're publicly flipped, and this is in the current regime, once we're publicly flipped, we wait our 15 days, we launch our IPO roadshow. Management is going with the investment bankers to meet with investors. Over the course of that week and a half of the IPO roadshow, those investors, either ahead of their meetings with management or after the meetings with management, are requesting from the underwriters to have conversations with the underwriter research analysts, to be educated about their views on the company, to provide them help in thinking about how those buy-side investors should be building their research models and thinking about a valuation framework. You could have effectively the same process play out during the pre-public flip testing the waters process. So we could confidentially file an S1. We orchestrate as underwriters a testing the water meeting schedule. And over these 3 or 4 days, 2-3 weeks from now, we're going to be putting the management team in front of all of these companies for testing the waters meetings. Those investors would be much more informed if they had the ability to take part in the research analyst investor education process ahead of those meetings during TTW. It would also, and if to take it a step further, and again, this is to take an analogous work stream from the UK process around the pilot fishing and valuation discovery exercise, the research analysts could be permitted to even have draft research or publish that research on a pre-deal basis. This just, again, would help with greater transparency in educating the investors. It would streamline the overall process, and it would help the underwriters in getting to a place well ahead of any public filing where we'd be able to educate the companies around how the investors are viewing their companies and their stories from a valuation standpoint. And at that point in time, it could be informative in terms of whether they want to continue forward with the process or to pivot and think about a different process or simply wait. But it would give them a lot more flexibility before actually going full open kimono with a public S1 before having those valuation discovery conversations.
So I think you answered this just a minute ago when you were talking about the UK, but earlier you had alluded to, how this works in other countries. Are there any other examples that you've seen that have worked really well besides what you just mentioned about the UK?
So I think the comment you're referring to, that was relating to the sell side analyst coverage dynamic. And so there are other, typically, so in particular in the UK, in Germany, the notion of issuer sponsored third party research is a much more easily recognized framework where companies can effectively commission third party research produced by independent analysts with published methodologies, conflict disclosures, and again, we've seen this in the UK. There are other firms. There's one called Edison Group, which publishes this type of independent third-party research. There are others in Germany. There are smaller boutique banks in the US that have this third-party commissioned research framework as well. It's not an established framework, and obviously it's not something that in practice I think it would, would need to be, there would need to be, relevant safe harbors for, to make these kind of, full, conflict disclosure and workable models that, could be adopted based on some of what we see in Europe.
So, Bo, I want to go more high level. So you mentioned at the beginning a recent 113 million, 50 to 60 and 50 million offerings. Can you talk, broadly why these companies are choosing to access the public markets for that capital versus, raising that amount, which we are seeing raised in the private markets?
Yeah, look, the private capital markets, are for a number of issuers, for lots of issuers, they can be very robust. They can be very efficient markets, but it's very easy, when you are, if you're obviously, cutting edge AI technology and, or if you have other Sandhill Road type of backing, those types of capital raises can help, can beget additional capital raises and can create a lot of buzz around, around different companies that, make the private capital markets very efficient and robust for them. That's not the case necessarily for every company. Not every company has the luxury of having, term sheets, on their desk from Sandhill Road every week. For instance, the companies I referenced, the company we took public last week is a founder backed company that's never really done outside institutional private capital raises. They've grown a business over, multiple decades that is, it doesn't jump off the page in terms of, some of the characteristics that make, that make, businesses in today's, market and the private capital markets, incredibly, attractive. But this is a very steady business that is a, steady grower that, manufactures critical metals that go into some very important end markets, including aerospace and defense. Sometimes these types of companies are better public market transactions where we can go out as part of a broader process to a number of different institutional investors that at the end of the day can have an easier time, getting approval from their investment committees to invest in that type of company because there is a liquid market for the security after the IPO. And we could go with that same company to, and we do a lot of private capital market transactions as well. And in many cases, I take a company out to investors and say, the company is potentially, looking to go public over the course of the next 1 to 2 years, and investors could be very interested in that business. They could find, having a lot of, excellent qualities, but at the end of the day, what they come back to me and say is, call us when it's time for the company to go public, because we're not really, we like this business. We don't like writing a check and having 1 to 2, potentially more years of illiquidity risk by investing in the private markets of this story. So, yes, if you're Anthropic, if you're OpenAI, it's really easy to go and get private capital and people are willing to take that illiquidity risk. That's just simply not the case for every company. And especially for some of these smaller cap companies, you can take these businesses to market, and there's a great market right now in, metals and mining is having a terrific moment right now. The rare earth sector are having terrific moments right now. We can take these businesses public and out to the markets, and we get a different level of receptivity from investors by this being part of a public market story, where if we see volatility spike massively, a month from now, 2 months from now, and if these investors have to, hit the exits because of stress they're seeing elsewhere in their portfolios, they have that liquidity optionality. But in a private capital markets transaction, they may not. So that's why it's just really important, for the IPO market and for the public markets to be accessible to these types of companies and not just be reliant on finding private financing.
Sort of continuing on that theme, when you're talking with companies and sort of advising them, I know the initial conversation is probably around access to capital markets, but once they are public, do you see any patterns on ongoing compliance cost? Are there other frustrations that arise? Do you see anybody going private after they've accessed the public markets?
Yeah, I mean, I definitely see it as a point of friction. I'd say more so for companies in their decision to go public. Once they're public, I think they're well aware and they've already accepted the ongoing public company costs. That's not to say that they don't want to see them ultimately, go down. I think they would love that. But for most companies, I see the cost element here as more of a fairly significant impediment to have companies wait longer to go public until they are of greater scale, have better profitability profiles, cash flow profiles, or just being an impediment to go public altogether, as opposed to something that people really change their minds about after they've gone public and they say, wow, these public company costs are really a burden. I think I'd like to take my company private again. I'm sure that factors in certain, in some cases, but I think it's really more a pre-IPO impediment to having companies really commit to the going public process.
Well, as you laid out your 5 points, I'm going to assume you didn't put them in order of easiest to do.
No,
Because I looked at 4 and 5. They seem to be the lightest lift of all of them. And am I reading this wrong? And I'm asking that question for this purpose. This committee, we're tasked with making recommendations. Hopefully recommendations that the commissioners could look at and really sink their teeth into. Yeah. And just in looking, it seems like the last 2 are the easiest. Am I reading the tea leaves here wrong?
Well, I guess that I don't know. I guess that's really I don't know that I'm best suited to say which from the SEC's perspective would be easiest to implement. I certainly I agree with you.
I have to let me interrupt you. Forgive me for this, but Bo knows the deals, the elements he listed here. So if you had to give us the top 2, which would it be?
In terms of impact, I definitely think
I'd say least friction.
I think the second one is, from my perspective, in terms of just eliminating the 15-day waiting period. That's not something that that at least when I started my career that existed. I can't say that institutional investors were significantly worse off, and at that point in time than where they are today. Again, assuming just put it into practical terms, whether you do anything with pre-deal investor education, whether you change any of that process, whether we take anything from the UK or how they do it, or let's assume none of that changes. They're 99 times out of 100 today, IPOs are taking advantage of testing the waters. So in terms of getting, and I'd say on average, you're doing anywhere from 30 to 50 TTW meetings prior to a public flip. So the institutional investor community, even though they haven't had access to the S1 filing, they're still pretty well up to speed on a lot of these stories and these companies prior to them coming to market. And so I think compressing that 15-day waiting period, in my mind, I think that's fairly frictionless. And whether it's in a full elimination of the 15 days or a reduction to 5 days, we all know how much the market can move over the course of 1-2 weeks. It's an incredibly volatile world. And, I've seen plenty of examples of companies that flipped public, and in waiting those 2 weeks before launching their roadshow, the entire world changed. And then they were hung out there, publicly filed, and we're not able to launch the roadshow. I have some companies that flipped public back in January that still haven't launched their roadshows. So in my mind, I think that's an impactful one and is something that is fairly easy to implement. I think in terms of in terms of some of the tweaks I mentioned around shortening the S3 shelf eligibility, some of the tweaks around WIXI thresholds, again, I think those are fairly frictionless. And I think especially when you take into consideration some of the stats I gave in the introduction around the reduction of public companies, the average size of companies that have gone public, a lot of these rules in terms of establishing a track record of being in the public markets and being a public filer for these 12 calendar months, a lot of that I just don't think is as relevant today, and certainly not is not as needed as perhaps it was at a different point in time. But I think that S3 shelf eligibility, particularly for small cap issuers, if you think about a company in the first year after its IPO or first year after its de-SPAC, they are the optionality they have in financing themselves in that first year is significantly constrained. We've seen how much, how volumes have spiked. The ATM product, at the market offerings, that's emerged. It used to be just, certain sectors, utilized ATM programs. Now it's really across the board. Every sector utilizes ATMs. It's become good corporate housekeeping just to have those programs in place to take advantage of some of the swings you see in price, in volume. Companies that are not S3 eligible have no way of putting an ATM program in place. So even for a post-IPO company, if I'm a small cap issuer and I go public and my stock's trading well and I've got a 6-month IPO lockup, it would be really wonderful once that lockup rolls off to be able to put an S3 in place, put an ATM program in place, and just have more financing flexibility in the public markets. So I think that one's a fairly frictionless one. And look, the analyst coverage, piece of this, I think it can get tricky, admittedly, there's a lot of different, considerations, and, we're talking about going back to, global settlement, 23 years ago. And so I wouldn't necessarily describe that one as perfectly frictionless, but if I had to pick two, I would say 2 and 4.
All right, so I have 2 ideas. The first is moving the 15-day window down to 3 days, and then the second is moving the WIXI threshold from 700 million to 250 million. Do you feel both of these changes would increase the number of IPOs?
I think the first change would increase the number of IPOs. I think it would also make we'll put it this way. I think the first change, it may not necessarily spur companies to say, okay, now I want to go public because before I wasn't going to, but shortening from 15 days to 3 days, now I'm going to pursue an IPO. I don't necessarily think that it would change the mind frame for companies. I do think it would reduce the amount of companies that flip public, markets move, turn against them, and they end up not launching their IPO. They end up not going public, in some cases ever. So I do think it would be beneficial from that standpoint. I think the WIXI threshold going down to 250, I think, again, I don't know, I don't want to say it would spur additional IPO issuance, but I think it would give a lot of these IPOs, a much better chance of continuing to finance their growth plans, in the public markets. And so from that standpoint, I mean, again, if I'm, if I can have S3 eligibility, and whether it's 6 months post IPO or 12 months post IPO, and I know that, I can then very easly put up an S3, have it automatically effective because I have 300 million afloat. That does change things. If you think about the ability, I would say, again, 9 times out of 10, public financings these days, we try to do as much wall-crossed marketing to confidentially build order books before flipping a transaction into a public transaction. For an S1 issuer, you have a 2-day mandatory public marketing period. Stocks, we saw a deal, not one Cantor was involved with, but one of our competitors launched a 2-day public marketed deal for an S1 company that wouldn't have met S3 thresholds or WIXI thresholds. Their stock declined on the first day this deal was being marketed. The stock price declined more than 50%. They had to pull the transaction. They didn't get the funding they needed, and the stock is still languishing at those lower levels. So it's now eroded shareholder value just by attempting to go out and raise capital. If that company had S3 eligibility and had WIXI eligibility, they could have put a WIXI shelf in place. They would have had automatic effectiveness. They could have done their wall crossing, and they could have flipped that transaction into a public overnight transaction. And even if they needed to price that at a 20% discount, to get investors, into the stock, they still would have gotten the financing they needed. And the stock would have recovered because they would have been trading on the fact that they've now raised an additional $75 million of growth capital. So that would have a very big impact. I really do believe so.
I'd like to go back to this concept that these small cap companies that you're seeing go public, it's perhaps they're not successful in the private markets because they don't have that, VC or PE return model that those types of investors are looking at in the private markets. So if the theory is that the public markets are going to be more efficient at valuing those companies and pricing those companies, I do want to talk about analyst coverage, right? Because now we're talking about smaller companies that don't necessarily have that hockey, stick growth story. And so, yes, I agree. This is probably going to be one of the harder issues. But how do we prevent those companies from being invisible? So they were, quasi-invisible in the private markets. So let's put them in the public markets. How do we prevent that problem in the public markets?
Yeah, so I think, look, I think go back to two of the things that I talked about earlier. I think I think the easy solution there is to eliminate or significantly reduce the 25-day post IPO quiet period before research analysts can initiate coverage. I think that again, that initial trading period, if you think about a typical IPO, so let's say, for a small cap IPO, let's say it's a $75 million IPO, the first 3 to 5 days post IPO, that day after pricing, $75 million IPO, it might trade $100 million of trading volume. The second day after the IPO, it might trade $40 to $50 million of trading volume. The third day, it might trade $20 million. By the 7th, 8th day post IPO, it may only be trading $2 to $3 million of volume a day. So that initial period where there is liquidity out there are shares out there changing hands. I think it's for institutional investors and even for retail investors. For it's actually, it would probably be even more beneficial for the retail investor in terms of protecting those investors and giving them more information in the market. The institutional investors have at least had a chance to meet with management during the roadshow, to ask their questions during the roadshow, to have a point of view, to establish, build their models, establish price targets. Every institutional investor, they have the benefit of, they have their own models. They have their own price targets. They have their own, near-term targets, 12-month targets. The retail investors that are buying these IPOs in the aftermarket, they don't have any of that. And they don't have the benefit of being able to say, oh, well, I see, I can get access to the Cantor research and I can see at least, here, let me read about the analysis around this company. Here are the investment highlights. Here are the investment risks. If anything, they're reliant on an S1 disclosure, which we all know is much more, especially for a retail investor, is much more legalese than it is, a real practical understanding of here are the benefits, here are the risks, and here is my view in terms of my rating, my price target. So I just think having that, research in the market immediately after pricing would just create so much more transparency out there in the market for every investor, whether you're Fidelity or whether you're Joe Smith. So I think that's a very important piece of it. And then I think, the other aspect is, the idea of what I talked about before around pre-deal investor, education. And I think it's admittedly a little bit more of a controversial one to have analysts, writing those reports and publishing that and using it as part of a pilot fishing exercise, or, alongside the testing the waters activities, but at a minimum, to have the research analysts be able to educate investors, during that TTW process. It just starts the investor education and the research, education process much sooner in the process. But I really do think the thing that would be the most needle moving would be, that the ability for the syndicate banks to publish research in the immediate aftermarket, not have to wait 25 days.
And then how do you sustain it, right? So you talked about that drop off in volume. So the initial period, we would try to keep some of that trading volume, but what about 6, 9 months, 3 years down the road for these smaller companies that even if you can sustain some of that trading, they're probably still going to be thinly traded?
Well, I mean, I think there are a lot of things you can do that we've talked about, to help get more float out there into the market. Again, I think some of the considerations around shelf thresholds, shelf eligibility, shortening that timeline from 12 calendar months post IPO to 6 calendar months post IPO, to shorten, to lighten the WIXI thresholds, to give, as you give these companies more flexibility to do registered, freely tradable offerings of additional securities post IPO. The more flexibility you give them, the more they're going to take advantage of it, the more they're going to put that stock out into the market. That's going to help and enhance trading volumes. And that if you think about it again, right now, company goes public. If they're an S1 filer for 12 months after their IPO, at least. And so either they have to take on 48 hours of public market risk, which can in some cases just eviscerate stock prices, or they have to do an unregistered pipe financing. And then those securities, they typically go into a small number of investors, in some cases into one investor. Those securities are then registered 30 to 60 days after that transaction. None of that improves the float or the trading liquidity in any of those stocks. So the more flexibility you give them to doing registered offerings, that where you're giving investors and a larger number of investors freely tradable shares in those offerings, the more benefit you're going to have to improving those technicals and the trading aspects of those stocks.
All right, I have one more for you. So one topic we haven't touched upon yet, it's been in the press for the mega IPOs, but I'm curious about your thoughts for the small caps. The seasoning period to put these stocks into an index, right?
Mhm.
Is that going to help our small caps?
I think it absolutely would. I mean,
Okay.
it's, look, if you think about, so the indices that really matter, there are 1,500 companies in the 3 large S&P indices. The S&P, don't quote me on this, I'm not perfectly current on market cap thresholds for the S&P small cap 600, but it's going to be somewhere in the between $1 and $2 billion range in terms of needing minimum market cap. So that's not going to immediately help the 500 million market cap companies, the 700 million market cap companies. It's not going to help everyone, but it will help some of those companies. If you're a $2 billion market cap company and you do a $200 million IPO, and you can immediately have access to the S&P Small Cap 600, that's a meaningful demand enhancement in terms of where these just the amount of demand that can come into these stories. And so it's not perfect. It's not, if you're trying to drive incremental demand into the, a Russell 2000 index, that's not going to be as impactful as getting into the S&P Small Cap 600, but it still matters to some degree. And for a company who, again, if you're a $75 million IPO and you have Russell inclusion right away, or if you can get small cap 600 inclusion, right away, and it's going to enhance, your float by creating an additional 30, 40, $50 million of demand. If you're trading $5 million a day and you get an extra $50 million of index demand, that's a meaningful enhancement to your stock price.
Coming back to the research topic again, one question I had, you had mentioned sort of the issuer-sponsored independent research aspect of it. Is that currently prohibited by the existing rules, or is that just something that the market hasn't adopted? And if it's something that the market hasn't adopted, is there any indication of like what the resistance from the market is? Why haven't we seen more innovation in sort of like the research side of thing? Any thoughts on any of that?
I think it's, look, I'm not a lawyer, so I don't want to speak to the specific,
Technically, I
legalities
am,
around it.
so I should probably know. I should probably know the answer to that one, but
I think it's more that it's not something that in practice has been done in the U.S. Again, there are, there's a small boutique bank called Sidoti and Company. They have their own department that does issuer-sponsored research. So technically, I think this can be done. I don't believe that, it is, I think that it's something the SEC, I think, should be aware of and should make sure that to the extent it is done, particularly for IPOs. And if you're going to have issuer-sponsored research that's in print publication on the first day of trading, or even potentially on a pre-IPO basis, that the SEC is aware of it, and that the appropriate disclosures and disclaimers are, throughout that research. But honestly, I think it's something that would be beneficial to the market and should be considered. Again, if a company is going public and they're paying a firm like that for issuer-sponsored research, presumably there needs to be disclosure about that in the S-1 as well. So it all wraps into the overall IPO process, the disclosure requirements, your S-1, but it's something that, is done and utilized in other markets. It's not utilized here. Part of that may be somewhat regulatory driven. I think it's really more just a practical matter of that. It hasn't really been, pushed or encouraged, or that any, whatever impediments out there to it, it going forward, really just are out there.
All right, so I have one last question, but then I really want to encourage any other members of the committee to chime in, because I at least am finding this very, very helpful to understand, how we actually get these public companies to get the benefit of actual capital and liquidity in the public markets. So I guess going back to the issuer sponsored analyst research, right? If we think about one of the reasons that US public markets are so successful is because of investor trust in these markets, right? And then of course, we see movement in the market when there's, investor trust has been impacted. So how do you do that issuer sponsored research? I mean, is disclosure enough to maintain the trust? I mean, what kind of guardrails do you have to put on there to make sure that we are not eroding one of the really good things about our public markets, which is the investor trust.
Yeah. And look, I mean, obviously disclosure needs to be a really important element of it. You could go so far as to say issuer sponsored research cannot include price targets. It can't include ratings. It can't include, anything that would be you're telling an investor what they should do or how they should, but it would still be very helpful information if it was just educational research about the company. So, like how many retail investors are going to read through a 150 to 200 page S1? Like virtually none. And so, if you had a research report that is, initiation of coverage of a company that is going public, even if it's issuer sponsored, and if they're paying, Sidoti or whomever $400,000 to put out a research report on the company that's going to be out there that a retail investor or even an institutional investor is going to pick up, and they're going to read through a 22-page initiation of coverage that walks through the company's business, what they, who their competitors are, who they should be comped against in the public markets, who, just to give the framework for investors on how to think about it. You could include, the question of whether or not they include, financial forecasts. Like, I think you could get there on something like that. Again, these are research analysts that are, going to be spending time and diligence in the company. They could provide their research models, and then the investor could be left to determine, how they want to view that, what they want to do with it. They make their own investment decision. They put their own price target associated with that, their own rating associated with it. But you're at least giving them the bones to be able to be a little bit more informed about the story.
Great, thank you. That was very helpful. Does anyone online have any questions? We're going to look to see if anyone takes themselves off of mute. Okay, nothing online. Anything in the room? Any more questions from in the room?
I
Yes.
had a question. What would be the most, if you look at it from a first principle standpoint, an addition, an elimination, or a modification of a rule that would be most impactful? And if you could write it yourself and, you knew it would pass, it would happen, what would that be?
I would say an expansion. I'd go back to my first point, and an expansion of the testing the waters procedures that would allow for more complete valuation discovery with those investors, and sell side underwriter research analyst involvement in investor education on a pre-deal basis during testing the waters. I think that would be undoubtedly the most impactful thing for small cap issuers, because that is where, look, let's just, again, put it in practical terms. I'm a small cap company. I hold a bake off. I have 8 different investment banks come in and pitch to me and tell me what my company is valued. That's the investment banking point of view. That is, and hopefully, we're good at our jobs and we can, put forward very, accurate assessments of what we think, how we think the market will value it. But at the end of the day, we're not out in the market talking to those investors, and we're not gathering and aggregating those points of valuation feedback. That in our current construct, it is very difficult to do that until we're actually on the road, having launched the IPO, where there's a price range on the cover and we're building an order book. And unfortunately, for these small cap companies, that often happens 10 months after they've made the determination to go public and spent several $1 million. And it's just too late in the process. Again, I alluded to this earlier. It's a big part of why so many companies chose in 2020 and 21 to go public through de-SPACs instead of traditional IPOs, because you could at least, you sign an LOI with a SPAC sponsor and you got to go out and market that story to institutional investors, build your order book and establish valuation before you then went through your SEC process, before you went through drafting your S4 and getting that on file and going through your comment period. And it de-risked the overall execution of the transaction. So if we could come up with an analogous way to do that for traditional IPOs, I think that would be the single most impactful thing to get more small cap companies to commit to going public.
This has been super helpful. I guess one other just sort of global question, where it stands right now, is there sort of like a floor of, you know, you're too small of a company or the public markets aren't right for you? Is there a size at which that starts to kick in? Sort of part one to the question. And then part two is, let's say SEC sees the video, makes every single one of the changes that you want to make, plus a few more, reduces disclosure, and how much of an impact do you think that has on that same level, if any?
I think to answer your first question, the way I think about it, I think it would be, you'd be very hard pressed to get enough investors interested in IPOs that were really below a, let's call it $40 to $50 million threshold. So if I'm going to use that as, you know, my, you know, let's apply a reasonable float threshold to that. You know, let's assume, you know, even 20 to 30% of the company is able to be floated. You're talking about companies with market caps, you know, in the, let's say 200 million minimum. So if you go through this investor education process and the market comes back and they say, look, we think your business is worth $75 million, $100 million, it's not time to go public. Your investor audience is going to be far too niche. You're not going to be able to, you're never going to achieve the valuation you want in the public markets because you don't have enough investors that are going to say, that's big enough for me. For 50 million plus, you know, IPOs, companies with market caps, you know, there's plenty of very successful companies that start out at market caps, you know, 250, 300 million in that ballpark, and then turn into billion-dollar, multi-billion-dollar market cap companies. So I think I'd think about it, you know, from that standpoint. And then apologies, can you remind me again the second part of your question?
The second part was, so we make all the changes, that, you know, make it easier to get to market. Let's say we reduce some of the compliance barriers. Like, how much of an impact does that have on that analysis?
I think meaningfully. I don't know that we get back to, you know, 73, 7,500, you know, public, you know, operating companies in the US like we had in the mid 90s. I certainly, you know, could see a significant pickup in small cap IPOs. I mean, I think you'd have, you know, I think you could get back to, you know, the level we were at in the, you know, early part of the 2000s where, you know, we'd see 150 small cap IPOs a year. You know, right now we're seeing 50 to 60. So I think it could have a 2 to 3x, you know, impact on overall small cap IPO issuance.
So one question that may be a little bit provocative for an investment banker, but, you know, if we make these changes to make traditional IPOs easier, especially for small cap companies, how much of that increases the total number of companies, small caps, that go public versus just pulling away from the de-SPAC market into the traditional investment banking markets? So is it just moving the deck chairs around the Titanic, or is the total number of public companies actually becoming larger?
No, I think the total number of public companies would become larger. It's not, I mean, if you think about where the SPAC market, you know, the SPAC market, there's a place for the SPAC market. We are the leader in the SPAC market. You know, it is a great tool for certain companies. It's not like a one size fits all type of approach to going public. And, so I think that there will be some companies that still decide, I want to go out and find high quality SPAC sponsors. In some cases, some of those companies say, I'm 2 board members away, from being ready to be a public company. I need a strategic partner. Like I need somebody who can help me, bring additional capital into the business. And so I think some of those companies, will take that approach. I think that, so I don't think the changes we're talking about would necessarily, disrupt the, the SPAC market. And keep in mind also, the SPAC market is, from a volume standpoint, is nowhere close to where we were, 5 years ago. It's a much more selective audience of, a lot of repeat SPAC sponsors that come to market, have established a track record, but we're talking about a fraction of the amount of SPAC issuance that we saw 5 years ago. So, no, I don't think it's, you add one and take one away. I think it would be a real enhancement to the overall number of small cap public companies.
I have a quick question, and I don't know if you touched on this and I missed it. Would what you're recommending be broad across all industries, or more specifically, would it encourage no revenue entities? So now we're talking about early stage R&D to enter the IPO market more frequently than they are today.
I think that is a sector by sector there are companies that are, there are companies in the, in the mining space, in the exploration space that, are no revenue companies that go public, and many of which have very significant valuations in the public markets. Would it encourage a company that has no business being public? If you're a an apparel manufacturer that has $3 million of revenue, are you going to try to go public and, find dumb money in the public? Like, no, I don't think, if that's what you're asking, I don't think it's going to encourage, that level of behavior, because simply, I don't think that at the end of the day, these still need to be investable assets. You're going to, very, significant, thoughtful, and very disciplined investors that at the end of the day need to get these deals over the finish line. Most just about every IPO book is at least 80-85% institutionally allocated, and you need a lot of these high quality investors. So no, I don't think you're gonna be opening Pandora's box. If what you're asking is, I don't think you're gonna be opening Pandora's box to all of a sudden you have a lot of companies that have no business being public going public, because it's still gonna have a cost to it, and you're gonna have to have conviction and certainty that these deals can be, can get over the finish line and be investable.
All right. Well, Bo, thank you so much. This has been really, really informative. We appreciate all your thoughts, and maybe your magic wand will do some work. We can help with some of that. Appreciate you being here.
I appreciate the opportunity. Thank you very much.
Great. So,
Bye-bye.
Bye, Bo. Love to open the floor up to ideas. Yes, Rose.
I actually have a question for Joe. Right?
I'm intrigued.
Well, I mean, we were talking so much about this, the pre-deal investor education, right? So we're going to go test the waters. We're going to be sharing more detailed information with institutional investors. What are the guardrails? How are we tracking, right? Like, to make sure that all this material information ultimately ended up in the public markets, right? I mean, remind me, but get a list of investors, and FINRA's curious, right? Who talked to these guys when? What information did they have, right? How do you think about this?
I mean, in some ways, it's similar to what we think about it now. Who's engaging with which parties, at what stage of the offering, what information are they making available to whom, when,
How does it disseminate into the public markets? We have a very robust exam program that looks at these things on a periodic basis, especially, in the offering space under the testing the waters theories. I know the SEC also has folks that look at these things. So in terms of dissemination of information, we want to make sure that's fair, that it's to the right customers at the right times, that folks are operating within the existing rules. Bo mentioned a couple other things that I think we have some stake in at FINRA around like underwriter compensation. He mentioned we have one of the main things that the corporate financing team at FINRA looks at is underwriting compensation to make sure that it's fair and reasonable relative to the offering size to protect both the issuer and the investor. So taking that back and looking at it and making sure that we've thought about that in the context of the work that we're doing under what we call FINRA Forward, which is an evaluation of our existing rules, is something that we'll make sure we do. He also mentioned research. Obviously, FINRA has 2 rules on that. One's focused on the equity markets, 2241. I think there might be some misunderstanding of how at least the FINRA rules work as to the quiet periods. Because, for example, I think this group is particularly interested in the smaller companies. EGCs do not have that prohibition on underwriters issuing research post offering. So there might be some education to the industry that we could provide regarding how the rules are applied. But it also might be a fact that, you had the global settlement that just expired, and some firms operate under different principles as opposed to the rule-based requirements. So that's something we can look at.
Thanks, Joe. Love to hear thoughts of what people thought of our meeting today and where what you're thinking now that you've learned some more about the IPO markets from our speakers and each other. Go ahead, Vince.
Yeah, I was going to say, I started off with my comments and listening to both of the speakers as well as, the conversation amongst the committee. I think I'm even more adamant that we need to really be very disruptive. And I say that because we have the strength and the weight of being the incumbent leader in the worldwide capital markets, public and private, which is a great thing. And but at the same time, it comes with weight because we have an administration, incentivized parties. It's the way we've done it. It's the way we do it. So it would be great if we could, in a sense, disrupt ourselves and say, taking everything that we have, instead of being anchored by it, how can we leverage it? How can we leverage it with a fresh look and say, what do we want to build forward? Knowing that we have the most robust capital markets from a public sector and private market standpoint. And, I say this now as well, given the fact that, I think I'll say it again, we're in a unique position now. I think that we can really be very aggressive with regards to making changes that will really best position the nation. And I would say this, with the commentary, it really just, again, cemented the idea that our capital markets are a national asset. It's a national security issue, I believe, too. And it's probably principally one of our pillars from a national security standpoint, and also clearly from a commercial standpoint. And it's something that I think we need to act with urgency, because as I prep for the conversation today, it's whether it's within the country, looking at the new exchanges that are coming in play, and clearly Chairman Atkins had spoken in Florida to what was happening in Texas, but also looking at it globally, looking at other exchanges, and some of the materials reference Dubai and again the China Market Star platform as well. This is happening now. And, we reference and we have the conversation around AI and its impact. I mean, that's a small slither of the very fluid dynamics that are occurring worldwide. Not just from a technology standpoint, but, again, looking at all the market players and, the founders themselves and the investing marketplace, whether it be public or private. So I walk away today thinking this is a phenomenal opportunity. I think we have. I think it's a phenomenal responsibility that we have, and I think we need to act with urgency because I think it's I don't think we have a moment to lose, And I think this is an opportunity to actually, take the bull by the horns and do something that will really cement our nation's leadership from a capital market standpoint, and also really, fortify our ability to continue to be the private sector and innovation and capital market leader in the world, which is, I think, important not only to our nation and all our founders and investors and just citizens, but I think it's important to the world too.
I agree that we have a moment right now to be disruptive and to think big. And I want to make sure that in that process, we're not undermining that investor trust that is so key to the success of our markets. And I would say I started this, conversation coming and thinking about investor protections, but I do like the reframing of that's investor trust, right? Like these protections, the review, it creates that investor trust that is meaning people are willing to put their money into these markets. And so my concern is if we're so, disruptive, are we undermining those fundamental underpinnings that have existed for investor trust? So I'm not saying not to be disruptive and think big, but in a way that's really mindful of preserving that. I would say I also came into this conversation, we heard this from some, really thinking about that dynamic between the private and the public markets, and how do we enhance the public markets if we have sort of this robust, so many people can find things in the private markets. One of the reasons I was leaning into Bo's discussion, because I found it very informative to think about those companies that don't have that growth story, right? We've been talking about those companies that can't fully take advantage of what's happening in the private markets. And I think that's just a great example of the companies that would have, better valuation and price discovery on a public market, right? And so really showing companies of all sizes, of all industries, that there's these viable paths, right? But we don't get those companies that don't have the connections. And that's something that this committee has talked a lot about, right? How do you find your investors, right? So, but how do we encourage those companies to say, go public? Because now you have the investor trust built into these public markets that you finally are going to get access to capital, right? For some very innovative companies that don't necessarily fit the pattern recognition of, a large VC fund or, P looking for roll up, right? I'm less concerned about that tension of the private and the public after this conversation, to see that there really is a way to elevate the benefits, underscore, and make sure that companies actually are getting those benefits in the public markets.
Yeah, I would say that the way I view it is, and I think, it's interesting because as you look at the literature and we were talking, I think there's at one glance, you look at it from a deficit standpoint. We had such a robust public market, but now the public market's taken a kind of a back seat to the private market. Okay, we have a challenger. And then you view them as kind of competitive marketplaces with competitive interests, competitive players. I view it more as a U.S. capital market, a capital ecosystem, and within that, the leading capital ecosystem in the world, we have the leading public sector ecosystem, capital markets, and we have the leading private market ecosystem, capital markets. And I say, let's look at how we, with a first principles perspective, disrupting ourselves, instead of trying to engineer what we currently have a little bit better, how do we just scratch what we have? Again, I'm not saying we clearly all want to be responsible in how we do this from a standpoint of the marketplace, the platforms, the investors, the companies, the employees. I mean, it's the, the entire economy. So this is not, they're not mutually exclusive. You can be disruptive and be responsible. So the issue is how do you look at them from a first principle standpoint, not being anchored to what we're doing and how we're doing and trying to engineer it to be 10% or 15% more efficient. It's how do we structure this to really best serve our country and the world and the marketplace from a public market standpoint and a private market standpoint. And I would say that I think we need to be I would urge the committee to think aggressively, because I do think we need to disrupt ourselves. If we don't disrupt ourselves, someone else will. And I would rather it be us than somebody else.
Yeah, no, I think this is excellent conversation, and I agree with Rose that the what makes the value of being a public company and what makes the U.S. public markets as strong as they are is because there is that level of investor trust. There is so much structured disclosure. There's a lot of regulation around what companies have to say and how often they have to report out earnings and material events. And so that does build trust. And because there's trust, sort of synonymous with that, the risk then becomes tolerable to the investor. If the investor can't have trust, then he's not going to invest any money that has any perceived risk at all. But the more trust the investor has, the more risk that investor is going to be willing to tolerate. So, and all of the, not all, but many SEC regulations have been put in place over the years to try to protect investors from risk. And I think realistically, some of them do. And realistically, others do not. Like the 15-day waiting period. I don't think that protects anybody from risk. I just don't. So I perhaps to Vincent's point, the radical look is just re-asking the question of everything we're doing. Does this really decrease investor risk, or is this something that somebody thought one day might be a good idea and then it wound up in the regs?
So to that end, when we talk about the 15-day window and the WIXI threshold, there seems to be a kind of a consensus today among speakers and then the voting committee members that both of those are too high in their current state. And I wonder whether there's a willingness or an intent to vote on moving those down to a more reasonable numbers, which would continue to protect investors.
Yeah, so I think I would love to get a comprehensive list because I think there was those two clearly stood out, and there were several others that we heard across speakers as well as our opening comments, and just being mindful of the time that we have left in this meeting. I think it would be great to definitely have those on the list, Robert, and let's get a comprehensive list and to decide, how we want to spend some of our next meeting, or are there things that we can take action on now? Because one of the things that I heard loud and clear from the chairman and the commissioners was to put something forward that was big and comprehensive. I think there could be, maybe there is a magic wand to a lot of what all of our speakers said and what we said, if we want to think, big. Because I'm of the opinion that, yes, I think we clearly heard that it's not, de-risking it for investors. Taking that away is not going to erode investor trust, and it has real, benefit, right? So if you just look at that cost benefit, but then we also have to look on, what's happening after that with, analyst coverage, right? Is that going to change, like what are the things, right? Because we talked about, deal execution, right? So I think those are things that are going to help offerings get across the line, right? You're going to de-risk the deal execution, but what are the things that we can put out there that are going to change the calculus to do the deal in the first place, right? Because it's one thing, these people are already going to do the deal and we're, making it that they have certainty, right? So they're like, we want to do an IPO, but we're slightly on the fence because we're concerned about deal execution risk, right? That's one audience. Where's the other audience that's not even looking at it? They've completely written it off. How do we get to them to say this is a viable pathway? So I'd love to go around the table with what, Robert just kicked off, is like, and get people's thoughts on, what are the threads that we want to pull on, right? What do we want to think about in this comprehensive recommendation?
Want me to start? So I feel like I heard a lot of really good ideas today, but I need like a list that lists the really good ideas. I'm between quick wins and disruption. I think we have to evaluate them that way. And I feel like I can't evaluate today which ones are going to have the greatest impact. And that's really what we're looking for. I'm not looking to spend any time on changing a rule that's going to affect 5 people. Not interested in that population. I also, I focus on cost, which is deterioration to investor confidence. That's an intangible cost, and that's part of risk. And then also actual dollars to implement some of these things. I really like the idea of what's going on in Germany and the UK, but that would be an expensive investment to pivot that here in the US, especially, there's a lot of energy behind, we have the best capital markets, right? So why we're going to mess with that? That sounds great, but it sounds really disruptive and really expensive and potentially risky. So my vision is a list of what we've talked about today, and then some commentary on where the impact might be, but that would also include risk to investors and things of that nature that are not necessarily, I'm a CPA, so I'm a numbers person, but I also live in that sort of intangible risk world and how we might evaluate that. So those are my thoughts coming out of today.
Just going down the line, I think if there's, we heard from people who are involved in the transaction, an attorney and an investment banker, and all of these guys want to get the transactions done because that's what they do for a living, is they want to do the transaction. But I think you all are right that the number of companies that decide they even want to do this, how do you grow that? How do you make it less hazardous to be a public company, especially a small cap company? And I do think that removing the burdens or the obstacles to research coverage, whether it's the jobs, refining the Jobs Act or what have you, I think there's multiple things we could consider. But I think making analyst coverage easier so that you're not a zombie company that doesn't trade any stock because nobody's heard of you. So I think that's important. And I know it's outside the scope of this committee and outside the scope of the SEC, but I do think litigation reform that keeps, fear of legal backlash keeps a lot of companies out of the public markets. It's just true.
Yeah, so I just agree with both Wendy and Laura. We heard a lot of great considerations for how to really bring especially these small caps into the public space. And for me, I really resonated with what you said, Rose. I think we're talking about 2 different types of potential small cap startups that they might be looking into or might be actually IPO ready, but there are others that are not even thinking about this, or it might be on the spectrum, but they don't know whether this is something that's going to be viable. But we heard a lot of really, really great policy considerations brought forward. I really appreciated Bo's presentation about looking at what some other foreign markets are doing with the PDIE space. I think that brings a viable opportunity. I also think reducing the time frame is something sensible. I believe in disruption when it's going to be impactful And I think that there's an opportunity to really look at all of what we've heard. I think there's a confluence of factors that all seem to play a role into to why we're seeing sort of the drop off in the public space. But I would like to hear more about how education plays a role. And I know we talked a little bit about it, but for a lot of these startups, they don't know what they don't know, and so there's a real strong opportunity here to educate them on what's out there and the potentials, especially if we do become disruptive in the space. Education is going to be a big piece in that, and so. But I think that what's been discussed here is really, really a great step forward. But we want to be mindful about being impactful and not just doing something for the sake of doing it, and that it really makes a dent in the problem. And we really have to understand who we're trying to target, because again, I think there's different types of categories when we're talking about early stage startups. Some have access and opportunity to counsel, compliance, and others are not so much in that same spectrum. And so, just trying to figure out how we address both of those two different types of potential opportunities for those startups would be something that we should consider as we think about some of the policy work that can be done to open up the door.
I like what Wendy said. I would like a deliberate approach. I think it's probably worthwhile that, we get an opportunity to review today's notes. And I know that we get the presentations after the fact so we can go through them, and maybe the next session, I don't know if we have a interim session, interim session that we talk, or if we just do it in the next session. But yeah, I think these are big things to talk about. It'd be good if we all had a chance to look through them, look through today's notes, and kind of look at, as has been shared, kind of the impact of these things, and think about how we put together a framework, like a holistic framework, recommend something that would be positively very impactful.
Just comment. I love doing something disruptive and impactful, but also sustainable. Given the body of work that we're doing, I want to compliment our colleagues at the SEC, because two wonderful speakers today. We're walking away with a lot to digest and a lot to discern. So I will echo my colleague Wendy Stevens' suggestion that we get this information. It's our process, right? We come and get the data dumped, then we all go back and think about it and come back and we sound much smarter than we did before, right? So.
So my only, I guess, one of my big takeaways from today was a lot of the dialogue that the SEC has been talking and kind of coming into this had sort of a preconceived notion that a lot of the discussion will be around the disclosure requirements. And I actually was sort of surprised to hear how much folks didn't really think the disclosure obligations themselves were as big a deal as really speed to market. Which on one hand, I think is actually great news for the SEC, because I think those are by far and away the more solvable problems. And then the other big takeaway was that, the advantage of being public, which I think was one of the questions we asked over and over again, at least what I heard from this is the ability to very quickly take advantage of robust capital markets and, frankly, pricing discovery that public markets provide. And that the quicker you can do that, the more attractive of an alternative to the private markets it becomes. So there may be sort of a tipping point scale there where, yeah, you can go public and you can get capital quicker at better pricing. That is sort of the tipping point where all of a sudden this question of well, why would anybody go public when there's this big obligation? Well, because you can get more money, better, quicker, cheaper, faster.
George, are you on? Do you want to comment?
Sure. Yeah, no, I agree with everything that's been said. I guess as I think about everything we've gone through here, I kind of put it into two buckets. One is just how do you reduce the cost of going public, both in terms of time and treasure, right? So where are there ways that we can reduce the cost of disclosure? Litigation costs is something we talked a lot about, with things like potentially safe harbor on financial guidance as you enter public markets, scaled disclosure, finding ways to speed up the time to market, really looking at any waiting period. Like we talked about that 15 days, but are there other, we also heard the review period at the SEC can slow things down, really kind of finding where are all of the bottlenecks in the process and evaluating which of those can be skinny down a little bit. And then the other piece of it is, how do you make sure that companies that go public have ongoing access to capital in the public markets? And to me, I guess the two things that jumped off the page were, really getting creative on how to get analyst coverage on smaller cap companies. And I think Bo had a lot of really good ideas for us to unpack there. And then, we kept coming back to this WIXI concept and finding logical reforms within WIXI so that businesses have an opportunity to go back to the trough more often once they are in public markets. So to me, it was reducing cost and then ongoing access to capital, and that's kind of how I've been thinking through it, and look forward to unpacking those a little bit more.
Thanks, George. I think that's all we have online, Rose.
Sure. So in some of the advanced, materials and things in the public records that I know we encouraged committee members to look at before this meeting, there's no shortage of commentary and proposals out there about what the country and the SEC should do about the IPO market right now. One white paper that was sent in to the SEC touched upon a lot of the things that we discussed today, right? Research and analyst ecosystem. What can we do around that? The trading infrastructure and liquidity, specifically around small caps. We talked a lot about that, but I think there's also an underwriter and an analyst compensation. To Wendy's point, you got to have some dollars on the side of it, but to Joe's point, right, they're also looking to make sure that things are reasonable based on the size of the offering. One thing, again, this surprised me. I thought you thought, Bart, we would have more discussion on disclosure. I thought we would have more discussion around 12G. This is what was touched upon. This is what allows a company to have so many, stockholders in their company before they are forced to make public filings. This was dramatically changed under the Jobs Act. It was interesting. I think we touched upon it as an impact, but kind of like disclosures. For some companies, it's making a difference, but for those companies, they could probably already go public anyways, right? So compliance cost reduction was raised in these comments. I think it was interesting and confirmed by the discussion that the ongoing costs of being a public company are not what is stopping companies from going public, right? They're thinking twice about the IPO costs, but once they've gotten over that hurdle, they're baking it in, right? So I think if we incrementally reduce the costs of being a public company, I don't think we're moving the needle on getting more companies to go public. There's comments in there around changing regulation FD, right? So that's fair disclosure, making sure that everyone in the public markets has access to the same information. Wendy, again, I thought you had a good point about this, that even if a company doesn't have a compliance framework with the capital C as part of their titles, doesn't mean that they don't have a compliance mindset. And how do you tease those apart? SEC review times. Then the other was around that market architecture. Two things here was, the liability on the litigation reform, but also something that we did not talk about today, which was not just scaled disclosure, but actual sort of pathway markets for venture-backed companies to put disclosures out there. And I think we heard some of the opposite, which is more simplifying it, right? There is this room for scales and tiers, but, simple is better, as in most things in life. It's usually cheaper, too. I think in terms of, moving the conversation forward, there is pending legislation and, SEC rulemaking that we expect to be released. I mean, Jenny, Courtney, correct me if I'm wrong, before our next meeting, maybe?
We can't speak to the timing of when it will actually
Okay.
be
I
published.
won't hold you to it then. Okay. Okay. But there are things pending, down the street on the Hill, right? So there's the Invest Act that's sitting with the Senate. I think this is just a couple of listenings. There's probably, more and probably worth digging into, Main Street Listing and Act and Fair Act, right? So I think it would be beneficial to review our notes from this meeting, maybe, and again, just thinking real time here, getting speakers that can educate us more on what is pending, what is proposed, what has been rejected, why was it rejected, what has stalled, why do we think it has been stalled? To have an impactful, comprehensive recommendation to this SEC. I would encourage us, just like we did recently on preemption, which is not within the remit of the SEC, but I would still encourage us to put thoughts like that as part of a comprehensive recommendation, realizing what's in the SEC's purview, what would need to go, to the Hill, what would need to go to the states on, litigation reform, and have that voice to think big. And then come in July, things will have changed between now and July. That's good and bad, right? That's bad. We're moving a little bit slow, but I also think it's good that it'll help us be very informed, because I think we have received very constructive feedback for this committee to make sure that we're giving thoughtful things and not, sort of throwing numbers around and saying that sounds good in the moment. I take that feedback to heart. So, I open it up for any questions and comments about that as a path forward on this, very big topic.
Rose, I think you're spot on. I appreciate everybody's thoughts, and I think our speakers today were awesome. They did a fabulous job of explaining a lot about the nuances of the markets. I will take a little bit of a philosophical approach here, like Vincent did at the beginning. And the one thing that came up, it was pretty brief with something that Edwin said, which was that, private capital is by definition patient capital when you don't have a very robust secondary market. And public stock is very liquid. And when you were talking about investor trust, it made me think that it goes both ways, right? So I'm an investor in several private companies. If somebody told me, hey, you can liquidate this like 5 minutes from now, I'd be like, yeah, let's go. But you kind of ebb and flow with the company. Of course, I wouldn't do that to a lot of my companies, but you're trying to, the point is you don't have that accessibility that you do in the public market. So I think that's something that we also need to keep in mind as we're not just making decisions based on the statistics that we hear from, an investment banker, a lawyer, or whoever's, we're getting information from. We have to think about it at a high level and what it really means to these companies, what it means to actually get capital into the hands of small businesses, which is why we're here. So, go ahead.
So how about I do just a very quick rundown of the topics that I heard as we went around, and then I'm going to give just a lightning round for anyone to add, one or two that you didn't hear on the list. And Robert, I'm going to give you the heads up because I'm going to start with you because you kicked off the first two for our lists to make sure that I actually got everything. And then we'll have our homework for putting together the list of potential topics and fleshing them out for our next meeting. Okay. So the 15-day post-flip period, either reducing that or eliminating that entirely. Relooking at the WIXI threshold. For this, I'm also going to put the shelf thresholds side by side for quicker access effective. Cost, and on this one, I'm going to put it with the timeline reduction, right? Time is money. How do we reduce that? Research coverage making analyst coverage easier, right? This facilitates ongoing access to the public capital. Litigation reform. Education. So this, I think we heard two things, right? One was on the analyst side, the pre-deal investor education. But what I heard from Jennifer is actually the earlier education for our founders that never access the capital markets, and for our investors who are thinking about whether their portfolio companies should look, right, getting to those folks earlier to get more companies that are even thinking about becoming a public company. Maybe not as much focus on the disclosure requirements, but still looking at scaled disclosure, and that would be the emerging growth company, sort of how long do we keep that, and do we keep that do we extend it by a year? Do we also extend it by years and change the threshold at which you would lose it if before that time period you got to that public float? The quicker pricing discovery, I think that touched upon, and valuation discovery, a few things. Looking at bottlenecks generally. So back to this, there's some overlap here, guys. I was writing down real time. Looking at bottlenecks generally, time is money, SEC review time. All right, so lightning round. Robert, all right, I like it. Thumbs up. Wendy.
Beneficial ownership.
Okay, yep.
And, just the general improved communication and education on the rules, success stories, what not to do. So it's two different aspects of education, I think, is what we're talking about.
Right, sort of like the no quiet period for our emerging growth companies. Joe, maybe we need to get that out in the market a little bit more. Little PR blitz. Thanks, Laura.
I think you covered everything. We talked about flexible compensation structures for underwriters.
Okay.
But I think that was a FINRA takeaway. And then I thought it was mentioned about the 2 years of audit financials. Maybe that was said.
Oh, yeah, I think it came up. That's a good point. We didn't really pull on that thread. That came up in the context of your pre-IPO M&A and having to do combined companies. Yeah, actually, that's one would be worth talking about more, because that can be a true pain point. It also impacts the M&A markets.
Somebody brought up the SX rules. Do we need to make them more scalable?
Yeah.
I think we did hear that during the day.
Yeah.
And then the bottleneck issue was the fast tracking review process. If that was something that we could incorporate, I think on the SEC review side.
Great. Vincent, anything from you? Nope.
Can we go back to that? I think it just wasn't fast tracking. I think it's also triaging, meaning risk ranking what these filings are and not doing the exact same thing on review or having that 30-day time period.
Okay.
So I heard ECG period extension, either making it 10 years or tying it to revenue. There were some discussion about the communications pre-filing, so the 132, 134, 162, sort of how you communicate stuff once you actually have the prospectus out there. Section 11 underwriter liability popped up in a couple different places. And uniformity of various filing status. So small reporting versus big reporting versus WIXI versus that. And then I think you included S3 eligibility timeframe. So
yeah, I did. I put that in the shelf category. Yeah, and that's a good one. We do know a title of a potential SEC rulemaking being filer status, so we may or may not have that to dig into further. All right. some great ads here. So Marshall, I'll turn it back over to you for next steps and where we are in our meeting timeline.
Okay, well, our meeting time is up. We have 1 minute. To talk about our next meeting is going to be July 21st, which will be in person. And then we also have a meeting on October 27th. Really appreciate everybody's input today. Oh, George, do you have anything to add to the list? Sorry, I see you, but I didn't call on you.
Also on
Okay,
my
you're
side.
good. You're good. Okay, cool. Yeah, this was a really great discussion. Rose, thank you for taking that list down. It's really great to have a vice chair who's a lawyer and also other lawyers on the officer committee. So appreciate all that, and we will see you next time. Thank you to the SEC staff for taking good care of us.